Would you like to buy a stock while it's on sale? Does a market smashing yield of over 5% sound good to you? Want to invest in a business that's seeing an acceleration in its growth? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing high margin, addictive tobacco products to millions of people. Certain stocks out there have earned the nickname sin stocks. That's because they're involved in products and or services that could be argued as sinful. Morality aside, there's a lot of money in sin. Companies that provide tobacco products have been proving that for many, many years. They've been paying growing dividends many years. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Philip Morris International Inc., which appear to be trading at a significant discount today. Philip Morris International Inc., stock ticker PM, is the world's largest publicly traded tobacco company engaged in the manufacture and marketing of tobacco and related products. Originally founded in 1847, Philip Morris is now a $147 billion by market cap global tobacco giant. Fiscal year 2020 revenue can be broken down geographically as follows: European Union 37%, East Asia and Australia 19%, South and Southeast Asia 15%, Eastern Europe 12%, Middle East and Africa 11%, and Latin America and Canada 6%. They do not directly sell any products in the United States. The company's global market share is an estimated 28%, excluding China and the US. Their incredible market share is due largely to the strength and ubiquity of their Marlboro brand, the #1 cigarette brand in the world. This one brand alone made up 37% of their total cigarette sales volume for last year. To say that it's a dominant brand is greatly understating it. What's especially captivating about the investment thesis here is that Philip Morris is combining brand power with the addictive nature of their products. Most companies do well purely with brand loyalty, but Philip Morris kicks that up a notch by layering addictive properties on top of it. This creates an end product that is highly price inelastic. That is, an increase in price doesn't significantly reduce demand. This kind of pricing power is very uncommon, and that bodes well for the company's ability to increase its profit and its dividend for many years to come. Already, Philip Morris has increased its dividend for 14 consecutive years. That streak is as long as it possibly could be, as it dates back to the company's initial spinoff from former parent company Altria Group Inc., stock ticker MO, in 2008. The 5-year dividend growth rate of 3.2% isn't lighting the world on fire. However, the stock yields 5.3%. That's 4 times higher than the broader market's yield, making this a great income play. This yield is also right in line with its own 5-year average. And with a payout ratio of 82.9% based on midpoint guidance for this fiscal year's adjusted earnings per share, the dividend remains covered and positioned to continue growing at a low single-digit rate. In my view, these dividend metrics are clearly desirable for income-oriented investors. Looking at business growth, Philip Morris's revenue decreased from $31.1 billion in fiscal year 2011 to $28.7 billion in fiscal year 2020. Revenue is down mostly because of a secular decline in smoking, which has caused consistent drops in volumes year after year. At first glance, this looks bad, but I think it's a lot better than it looks. The company has experienced steep declines in volumes. For example, fiscal year 2020 showed an 11.1% year-over-year drop in cigarette volumes. But even with this backdrop, Philip Morris is able to keep things fairly steady. That's impressive in my view. Moreover, and more importantly, the company actually grew its bottom line on a per-share basis over the last decade. Earnings per share increased from $4.85 to $5.16 over this 10-year period, which is a compound annual growth rate of 0.7%. 7%. It's important to note at this juncture that Philip Morris features an idiosyncratic accounting structure. Their headquarters is in the US, but they don't sell any products in the United States. This sets them up for somewhat volatile GAAP earnings per share when they convert foreign profits back into US dollars. Share repurchases aided bottom line growth. The outstanding share count is down by about 12% over the stretch. We can see that the company is growing its profit and dividend despite a secular decline in smoking. That sheds light on the pricing power I already noted earlier. All that said, what's so compelling about a business that's basically treading water? If the company can manage some earnings per share growth with steep declines in volumes and a strong dollar that reduces its reported GAAP earnings per share, could it not do a lot better with growth in volumes and a weaker dollar? I believe so, and I'm not alone. Looking forward, CFRA is forecasting that Philip Morris will compound its earnings per share at an annual rate of 8% over the next 3 years. This leads us to the crux of the matter. The company's strong pricing power can allow the business to advance at a slow rate, even if volumes are contracting and the dollar is strong. But a weaker dollar of late works to their favor. The bigger story, however, is iQOS. iQOS is the revolutionary heat-not-burn tobacco product. Whereas traditional cigarette volumes contracted by 11.1% in fiscal year 2020, heated tobacco shipments increased by 27.6%. Philip Morris is embracing technology and the future of their industry, and it's helping the company to offset the secular decline in smoking with a product that offers growth potential. The iQOS is relatively new, but results thus far have been encouraging. If we look at a more recent bottom line growth picture here, Philip Morris compounded its earnings per share at an annual rate of 3.6% over the last 5 years. There is a company-wide growth acceleration occurring here. It's not massive. It takes time to turn a big ship, but it is real. The worst case scenario, in my view, is that the dividend continues to grow at a low single-digit rate. But since the yield is so high, the status quo should be acceptable. Meanwhile, I see a lot of possible upside as it relates to future dividend growth. Moving over to the balance sheet, the company has a solid financial position. The long-term debt-to-equity ratio is not applicable because of negative common equity, but their interest coverage ratio of over 16 indicates no issues whatsoever with their debt load or interest expenses. Profitability is quite robust, as you'd expect. They command nearly unrivaled pricing power on high-margin addictive products. Over the last 5 years, the firm has averaged annual net margin of 25.5%. ROE is again not applicable because of negative common equity. I view this as a slow-growth, high-yield stock ideally suited for income-oriented investors. And with a growth acceleration playing out, this stock is arguably more compelling as a long-term investment than it's ever been. The company also benefits from durable competitive advantages, including strong pricing power, brand loyalty, global economies of scale, and high barriers to entry. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The very business model introduces regulation and litigation risks that exceed what the average business would typically be exposed to. There's also a flip side to that coin. The entrenched players, while competitive with one another, are unlikely to see any major new competition ever. It's virtually impossible for a new cigarette company to start up today. This has created a global oligopoly. It's also important to keep in mind that Philip Morris doesn't really fall under the regulatory jurisdiction of the US FDA. I view the general US regulatory environment as particularly unfavorable for a company like this. Since Philip Morris doesn't directly sell products in the US, this reduces some of their regulatory risk. The US dollar is a somewhat unique risk here because of the aforementioned accounting idiosyncrasy. A slowing of worldwide adoption of iQOS would reduce the company's ability to offset traditional cigarette volume declines. A recent legal setback regarding the company's ability to market iQOS in the US through Altria Group is evidence of this risk. Lastly, a further rise in traditional cigarettes volumes declines would hurt overall growth. I believe these risks are tolerable when looking at the whole picture, and with an appealing valuation, this name looks enticing right now. The stock has a price-to-earnings ratio of 16.3. This is well below the broader market's earnings multiple. It's also well off the stock's own 5-year average price-earnings ratio of 19.2. Then there's the price-to-cash flow ratio of 13.2, which is significantly lower than its own 5-year average of 15.2. And the yield, as noted earlier, is right in line with its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate to account for the high yield and a long-term dividend growth rate of 3%. I'm being conservative with my dividend growth rate. It's lower than the company's demonstrated long-term dividend growth, including the 4.2% dividend increase that was announced only in September. It's also much lower than CFRA's near-term earnings per share growth expectation. As I stated, there's a case to be made that future dividend growth can surprise to the upside. However, I'd rather err on the side of caution as the long-term earnings per share growth is below 1% and the payout ratio is somewhat elevated. The dividend discount model analysis gives me a fair value of $103. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Philip Morris as a 4-star stock with a fair value estimate of $108. CFRA rates Philip Morris as a 4-star buy with a 12-month target price of $110. I'm on the low end this time around. Averaging the three numbers out gives us a final valuation of $107, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. Philip Morris International Inc. operates a high-margin business that benefits from nearly unrivaled pricing power. Recent growth acceleration portends a bright future. With a market-smashing 5.3% yield, inflation-beating dividend growth, more than a decade straight of dividend increases, and the potential that shares are 14% undervalued, this high-yield stock is ideal for income-oriented, long-term dividend growth investors. And now for a special news announcement. Atmos Energy Corporation, stock ticker ATO, just released results for the fourth quarter and full fiscal year 2021. Good stuff all around, guys. Revenue grew 19.7% year over year for the quarter, and adjusted earnings per share increased by 8.5% for the full fiscal year. I highlighted Atmos Energy as an undervalued dividend aristocrat only weeks ago. This quarter only further convinces me of the opportunity here. Take a look at this name if you haven't already. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.